Joining me here in studio, Cem Karsan is a senior managing partner at Kai Volatility Advisors. Great to have you here, Cem. Let's talk a little bit about this session because it feels like you've got a real battle going on here. ARM is like invigorating all the tech. Even Apple's back in form today. But then those three horsemen of inflation, dollar, crude, rates, going the way I would think bulls don't want.
Macro versus flows. Does this sound familiar?
Yeah.
It's been the story all year. Essentially, at the end of the day, the increase in interest rates, right, that we've been seeing, that's been secular, despite a couple blips along the way, paired with all of just the draining of liquidity that's coming across the market with a lag, has all been overwhelmed by something that's more important ultimately, which is vol is very well supplied, and all of the buyback, all of the rebalancing underweight in the markets, all of that combined has been a consistent push up, and we've talked about this again and again. This SEP OpEx, so important to that. Big quarterly OpEx, you have a ton of open interest, particularly on skew due to structured products. What does that mean when vol is compressed? That stock all has to be bought back. All of the stock that dealers are short has to be bought back into this period.
Okay.
Unless we realize to a sizable enough amount to the downside. We didn't get that.
Yeah.
It's been clear. We were clear. If you don't get in this window, time is not a bear's friend.
Yes, that's
right?
something you've been saying a lot, and it seems like that's been the case. We've gotten those little steps, but never the break. We've taken a few stair steps, but we never really opened up the trap door.
And if you don't open up the trap door, the flows are coming back. Get out of the way, particularly to these big open interest, SEP OpEx, DES OpEx. There's something additional to that now, because now we're entering a strong seasonal period.
Okay.
And if you
for flows,
for flows,
because generally history says September's not good for the S&P, right?
the back half of SEP.
Like if I get the almanac out.
The last 2 weeks of SEP represent this window of weakness after the SEP OpEx, right?
Okay.
After these flows push up. That's still there. But because vol is still so well supplied, everybody's been long. October, November, December vol behind the SEP that they've been short on the dealer side. They're decaying longer and longer vol, shorter and shorter delta. Not only do the deltas have to get bought back, but now it comes more vol supply. And if you can't realize enough to the downside, the window is closing into the end of the year. Why? What are the reasons that seasonality exists? It's not a magical construct. There's two major things. One, at the end of the year, when the market is up a sizable amount, that is a re-rating of collateral. You have new dollars, new money being created by outperformance of risk assets. Almost 20% up for the year. That's a $40 trillion market that just increased by 20%.
Okay.
$8 trillion more of capital this year. Maybe not all of it's going in Jan 1, but let's say 10% of it does.
So the price action begets flows in a way?
Correct. There's a momentum factor to this. We talked about this last year. Last year, everybody's like, here comes Santa Claus, here comes January effect. I was very adamant. No. Last year it wasn't going to happen because the market was down. Those flows go the other way. Most years the market's up, so Santa Claus and January effect are a very strong historical pattern if you just look at it in that respect. But that's not the reality. When the market is up big, it is a massive positive tailwind because, again, if it's $1 trillion only, let's say just a small portion of that $8 trillion of re-rating of collateral, $1 trillion going to work in Jan 1, where the incremental flows are 50 to 75 billion a day that move the market. It's a massive amount. Of course, it gets front run into the end of the year. There's a chase because people have to keep up. That's issue one. That's the biggest one as we get to the end of the year. Almost as big, though, is the time-weighted volume of the market is dramatically lower, 30% lower in November and December and early January because of more holidays, and not just holidays, but holidays where the days around them are very slow because nobody's in the office on Thanksgiving. Nobody's there around Christmas. Beginning of the year, same thing. All of these days off, all of this volume-weighted reduction in time creates accelerated Von and charm flows, particularly into a DES OpEx, which is the greatest open interest in a January OpEx for a single stock, the greatest open interest across the market, period, every year.
Sounds like bears have got their work cut out for them.
So you have a couple of weeks here, but that's closing, it's going, and you don't want to be behind. People see it coming. You know, you have a very, very short 2-week window, and I don't think the odds are very good for that. And we've been very adamant about that the last several weeks.
Odds aren't good for a big breakdown?
Correct.
Okay.
Yeah.
The other thing on the calendar right now, the market basically is saying September, no chance of a hike, forget it. November, maybe. December starts to get a little bit closer to a coin flip. Could that disrupt the apple cart here? Give me the Cem macro take, or is Powell going to stay passive and pause?
So the macro take is intrinsically tied to the market. If the market continues to push higher, right, the economy continues to stay strong, labor rights, as we're seeing across the market, continue to force higher wages, the economy is going to stick in. And if that continues to be the case, guess what? Christmas is going to be a happy Christmas. And what do you think Powell's going to do about that? Is he going to continue to keep letting this go? Look at what happened with the ECB today, right? They have to continue to fight inflation. This is way stickier, way higher for longer, and the market is sniffing it out. If you look at yields, they're about to break out. That's the thing that ultimately, put on your calendar, circle January 17th. After the January effect, if we continue to get, and Santa Claus and into the back half of this year, if we continue to get to new highs or near new highs, double top, minor new high, that's a perfect time after those flows come out for a January, February issue, and it could very well be tied to interest rates starting to break out during that period into the end of the year.
That's kind of the calendar process that I was thinking based on what you said, because if the short term here for SEP expiry for bears is going to be a tough gambit for them to apply enough pressure, and then you get some of those seasonal effects, low volume and quiet kind of around the holiday season, economy strong, get a nice bid into stocks, then maybe we really get that forced hand of Powell next year once we see how kind of the spending season goes. I have another question too, though, which is like, you talk about how if bears can't break it, then that kind of builds the momentum. It sort of builds on itself, those flows. What about if we don't get to fresh all-time records? Because if I'm a simple guy and I can draw the line on the chart from the previous high, and we got within 5% in this big bull market the last 11 months, what if we fall short again? I mean, is there something to be said about that trend if you zoom out?
Could this market go sideways instead of getting the blow off top? Sure, but that probably extends the cycle, given it's an election year next year. You almost want, if you're a bear, this market to kind of push higher another 5 to 10%, right? Get to those highs, get people excited about 5,000, 5,200, right. Get on the bandwagon
Suck
again.
them in, and then pull the rug.
And then unwind it. And it's not just sentiment. It really is positioning based on sentiment. This is what we've been talking about for some time, the blow off top. This is how these things tend to end, because you need to reverse that positioning in order for the flows to now be in line with the macro, and eventually macro will be right eventually. Those flows are dominant in the long run. But in the short term, just look at 2000, just look at 2007, look at the Jan-Feb period we've highlighted going into COVID when we knew about COVID. These things you need to squeeze the short positioning, unpin the vol. If you squeeze high enough, that vol comes up, that market up, vol up we've talked so much about. I would expect to see that as we get into January, if this thing continues to stretch December and January. And at that point, vol can become unpinned and positioning can get squeezed, and then you can go the other way.
Real fast, because we're out of time, and I know this is kind of the layman's vol stuff, but VIX right now is at lows. If bears can't make that push in the window that you described this week, could we be talking VIX 10 again?
Yes, it could happen. Do I think it's going to happen? No.
Okay.
The reason it could happen, and you could see some real steepness to the volatility curve if that does happen, because I think longer term vol will hang in.
Okay.
But the reason you can see it is because structured vol supply from structured products is so dramatic. We've been talking about this publicly now for several months, but you're seeing such an increase with the increase in interest rates of structured product issuance that banks are taking on massive amounts of volatility, implied volatility, and they're having to force that onto the market. That is pushing the S&P specifically vol down in a dramatic fashion, which is leading to historic dispersion. So on the wings, the AI names, the areas where they're short vol are squeezing, right? They're moving, but that's causing a massive correlation breakdown. Meanwhile, the index is remaining very well supplied and pinned. So there's a massive structural issue going on, and that's not going away anytime soon. That has to be squeezed out with some type of dramatic moves.
Yeah.
At blow off top would fit that
okay.
More.
And we never got the dramatic move to the downside. We had a few attempts, knocked on the door, but the trap door never opened. We never got that unpinning, as you described. And a good lesson that time not the bear's friend. All right, thanks, Cem. Glad we got your thoughts, as always. Joining us from Kai Volatility Advisors.